Okay.
Kita na slides ko, guys.
Yes, we see it.
Okay.
Thank you.
Right. Okay, 2 p.m. Let's start. So welcome everyone. Thank you for participating in today's lecture. So for today, I will be doing a session on deep dive analysis. So this should complement all your fundamental analysis content from the previous days. My name is Quevedo. I'm from the global research team. I am a colleague of Nell, the lecturer yesterday. Okay. So let's go through the outline for today. We'll start with the goal of deep dive analysis. We'll be checking what mindset you should be using as an analyst. We will try to assess megatrends, narratives, your moats, especially your perception, especially since we're in the pricing game. Near the end, we have to synthesize all your research, and this is where our the fruition should be seen, which is for re-rating. And then I'll give you an introduction for a 5-year valuation model that we use, although this is going to be a bit light on that end now. Okay. So I'll be opening up for questions before moving on to each segment. So if anyone has any questions before moving on, just blurt it out. I don't need to see your virtual hand or anything. Just unmute and then say your question. Right? Okay, so the objectives today is to give you an introduction into how our team, particularly in research, approaches our deep dive analysis, and also to reinforce certain concepts in fundamental analysis. So we're gonna be trying to apply what you've learned from the previous days and see how we look at them on a day-to-day basis for our analysis on companies, right? So what is the goal of deep dive analysis? So ultimately, the goal of a deep dive analysis or doing a deep dive analysis is for you guys to make a call. Okay, so it's not an analysis if you guys just regurgitate facts to us. If you do your research and you're just gonna give me like numbers and facts and whatnot, that's not an analysis. Okay, we have to be able to make a call, and that call or thesis depends on what your trading goal is, and varying levels of fundamental analysis will apply to varying levels of trading styles and different trading styles as well. So for the purposes of this lecture, we'll try to align ourselves with how our investment fund does our deep dive analysis and how important it is for us to do our deep dive analysis. Okay. So for the fund parameters, these are the fund parameters that we have. So the goal is to be able to find mispriced stocks with a significant upside. So these are your runners, what we call runners, or they're more commonly known as multi-baggers, right? And so the time frame we have for the fund is significantly longer than what you would expect for the rest of the firm. We have a 3 to 6 month time horizon for our trades. That this doesn't necessarily mean that we hold for 3 to 6 months at the minimum. It's just that our expectation for a stock to move is within that 3 to 6 month time horizon. And to achieve these goals, we need higher levels of convictions. Really, we set a really high bar for our stocks and for the companies that we look at. So the edge in stock picking is expressed through our research, and we are heavily biased on fundamental analysis. And given that we focus our attention to the U.S. market, we have dabbled before in Hong Kong and Japan, but really we see that our edge and most of our time is spent studying stocks in the US. And so on making the call, please do not mistake making a call with having a call. So I did say earlier that we have to have a call during your deep dive, but that call could easily be, I don't know, or I can't have conviction, right? Inevitably, there will be times where doing deep dive analysis, you can't synthesize as well, and you can't find all the needed information that you have, that you need. So in your deep dive analysis. So making a call does not mean having a call all the time. And so because of the goal of our fund, our analysis really tends to have a higher bar. And so we toss more than we keep actually. We can get ideas from various sources, like from movers, from other traders, but Once we do our deep dive analysis, we try to really whittle them down. And the first bias that you have to understand, that you have to be aware of as an analyst, is that you have to like a company because you took the time to read up on it. Please be aware of of a tendency to have this bias. It does not mean that you took your time to understand a company that you have to like it automatically because you invested time and brain power on analyzing a company. At the end of the day, if it's better to have no call at all versus an overconfident call, because an overconfident call can mean that you're gonna take action on something that's potentially wrong. So just key reminder, objectivity here is a key skill in doing our analysis. And so doing deep dive analysis is always a balancing act. So the inevitably the more you read into your company, the more data points you'll be able to gather. So the key to analysis is to classify all your data points and assessing your data points. So which data points are worth keeping? So gauge how closely related they are to your research. If the data points don't really move the needle for your research that much, maybe that data point isn't really important. At the same time, you have to assess all your data points and figure out to what direction they point you towards. Is a data point a plus point, a plus for your company or a negative for your company? And even if you discover negative points for your company, you have to keep them, especially if they are important, because data will vary in importance to your thesis, but at the same time, if you give um, only weights to the positive ones, you'll be ignoring the negative points there in your research, and again, that might lead to overconfidence as well. So gauge how important they are, to what direction they point you towards, especially um, never discard the negative data. That's confirmation bias at its root. So all of these must do a push and pull balancing act during your research. And so the call that we aim for really is whether there's a mispricing, right? So this was given to you by Nell yesterday, and I just wanted to highlight um, key key points in this image from Aswat Damodaran, which is we have tools to assess the gap. So there are price catalysts, behavioral finance. So this is your perspective and your perception into the stock. You have tools for pricing, which are your price multiples. Sorry, your price multiples. You have a pseudo DCF, which is our 5-year valuation model later on. We have drivers of price. For this is sentiment as well. So you'll be learning about sentiment later on during the course of the bootcamp. And I want to highlight this, which is the drivers of the gap. So it's important that we figure out what drives the gap between intrinsic value and price as well. Um, and usually it's information or the lack of information there. So moving on. Okay. Any questions so far? All right. So generally for an analyst, the what we usually have as a mindset is that the market is generally an efficient market. So if you guys want to learn more about that, you can look up the efficient market hypothesis. And generally, basically what this is saying is that the most information can be gathered for a company has already been discounted in the market. So that being said, it's truly rare to find mispriced companies. And so we try to, this is part and parcel why we really focus on the US, because it's really a bigger market than the Philippines, Japan, or Hong Kong. And probably the biggest market there is right now in terms of stocks. And the bigger your market is, the better the odds of finding mispriced companies. So every now and then you'll find pockets of inefficiencies in a bigger market, and so the odds of having mispriced companies is bigger and enough for the fund to play in. Okay? And of course, you're against better research and more well-informed players. It's just the most obvious disadvantage that we have right now, is that we're not in the US. We can test products as easily as we can versus local companies in the Philippines. We can't have direct contact to customers and figure out customer reviews and whatnot. We so yeah, that's one glaring disadvantage, right? So and other analysts will really have better connections and better specializations than we do. If you were introduced yesterday to ARK Invest, so ARK Invest is really unique in the way that their analysts are actually people from the field that they're analyzing. So, for example, you have some analysts that work in the automotive industry that analyzes EVs, or they have analysts that are from the biotech industry that analyzes gene therapy. So um, it's obvious that they're gonna have more knowledge than we do in terms of the products and industries that they cover, right? So keep that in mind, because if you think you have a unique idea or data point, think again. We're not living in the olden days, right? Where every other market participant needs to like mail order almanacs and annual shareholder letters and figure them out. Right? Everything is in the internet right now. Almost everything is in the internet right now. So we're living in an information democracy age, and so this acts really as a double-edged sword, right? So for us, information is easier to get because we can just do a quick Google search, and it's the same as well for the other market participants, right? So obtaining unique information edge has become much more difficult right now. But at the same time, it kind of equalizes our footing as well. That even if we are in the Philippines right now, we can still have a bit of a um, we can still have we can still have information, a lot more information that we used to do before, um, just because of the internet. And luckily for the firm, we also have the Bloomberg terminal. So I'm not sure if you guys will be able to access it, but I'm sure the organizers will be able to help you out with that. Okay. And so the process really looks very linear. So you start off with your company, you develop a good foundational knowledge on your company, and then you find data points to either point you towards your thesis or negate your thesis and whatnot, and then you conclude. But for our team, we really put importance on discussions, and discussions will help us in a lot of ways. And then really I urge you guys that if you are working on your analysis, you try to discuss with other people your ideas, your company, try to explain to them your company, and figure out the merits of your ideas, because doing this alone, you're especially if you're not mindful of all your biases, is is a it's a bad disadvantage for an analyst to lose that objectivity further down as you progress your research, right? And a key principle that we always have is that our research is always a work in progress. We may conclude it today, but after like an earnings release or material information that leaked to the market, we reassess. We have to reassess our research as well. Has something materially changed? Has something not material? Is it still the same? Do we still like it, etc.? So it's always a work in progress. And so discussions within the team, it gives you several benefits. The team can act as a sounding board for your ideas, whether or not you're being too biased, you're being too optimistic, or being too pessimistic. Um, Members can help fill in the gaps in your research. You may be able to figure out that there are holes in your ideas, or some gaps that can be filled by the knowledge of other team members, because they've been able to analyze several other companies within the same field. And so also discussion gives us an opportunity to actually filter out the ideas that we gather. So before we do a deep dive analysis on every company, we try to discuss the merits of the idea, if it is really worth doing a deep dive analysis on, because opportunity cost deep dive analysis will take time. And so if the potential of finding a mispriced company early on seems to be slim for a certain idea, we will likely have to lower its priority for deep dive analysis, or eventually just toss it out. And so yeah, we toss more than we keep, essentially. And so overall, even though the process looks very linear, this is what we have in our heads, right? So it's a synthesis of all the data points and all the narratives and numbers to create your moat analysis, your competitive advantage analysis, your megatrend analysis. Everything has to come to a head and develop a thesis, right? And the aim is to gain a synthesis of knowledge about the company that you are doing a deep dive process on. And um, you have to understand that this is what's in our synthesis is very important, because every data point that you gather will inevitably push or pull the relation to other data points, and it will affect your overall thesis actually. So you can be careful in assessing your data points separate from each other. Figure out the relationship of your data points with one another, if you can, and see how they affect all your other research material that you've been able to gather so far, right? Okay, so any questions before we move on? Okay, so just a quick recap why we focus on megatrends, right? So megatrend will offer varying degrees of uncertainty, but there is uncertainty in having a megatrend, because really the future is an uncertain future, or a future that's very different from what we have as a status quo right now. It's very hard to forecast, right? And a higher degree of uncertainty provides us with more level playing field than other players in the market. So we have a glaring disadvantage, that's for sure. Other analysts are more resourced, more capable of analyzing companies, especially if the company is domiciled in the US. But at the same time, if the uncertainty is at such a level that even them can just do a best guess scenario analysis like we can, then that gives us a better playing field. And that gives us hopefully an opportunity to express an edge over them, right? So aside from that, megatrends will provide tailwinds for your companies, right? In the face of uncertainty, if you have a higher level of uncertainty for your company, being very highly convicted, however, on the megatrend on which that company is participating in will give you will improve your odds. So again, you have to realize that deep dive analysis also is about stacking odds towards for your company, right? In figuring out whether or not the chances are high for mispricing, the chances are high for a mover to develop for your company. Okay, and so if you're assessing your megatrend, having a megatrend is all well and good, right? But even megatrends will have varying degrees of effectivity for your company, and so I believe that assessing the megatrend is also important for your deep dive analysis. So if you're gonna assess your megatrend, always go back to the key principles of what a megatrend is, and it should be able to define the future state of the world, right? So question whether it's a trend or a fad. All right, is this a megatrend that will be sustainable, or is this going to be contained to a certain geographic area, to a certain population demographic, and will not really going to be far-reaching in terms of its capabilities to affect the future state of the world, right? So let's go to examples. Renewable energy, definitely. Renewable energy has been here for many years, and fossil fuels um, will inevitably run out. It's sustainable because it's for mankind. Um, Before we run out of fossil fuels, we have to sustain ourselves, right? And is it far-reaching? Yes, of course. More countries are accepting the move towards renewable energy and trying to downgrade their carbon footprint. If you look at the Paris Accords, a lot of countries are there. The US tried to get out of it because of Trump, but now I believe Biden is going to get back into it because um, his um, his administration really is going for green energy as well, right? What about remote work? Will this kind of working environment persist? I believe so. Um, Remote work has been in varying degrees even before COVID hit, but is it going to be sustainable? Sure, but to what degree? Now we have to question to what degree is it sustainable and to what degree it will affect the the future, right? So remote work, Is it gonna be like everybody's just gonna stay at home, no more offices, no more buildings? Or is it gonna be a hybrid environment? If it's gonna be a hybrid environment, how much of a hybrid environment will it be? Will it be 1 to 2 days in the office, 2 to 4 days at home? So you see varying companies and various industries still want uh, um, the office space. They are proponents of the office space because they're touting that you need to build up the culture within the office and you can't do that at home. So etc. etc. So is it far-reaching? Yes, of course. COVID has given us um, has actually really progressed remote work and the need for alternative forms of working. And yeah, and another one, cryptocurrencies. Will it define the future? The question really is if crypto can be accepted as a store of value, right? So if that's the thesis behind it, that's still very highly questionable. But blockchain technology as a decentralized validation technology for ownership, etc., and security purposes for cybersecurity is a really good technology right now. I believe it's a very good technology. On the other, so it's showing promise. Right? NFTs, it's a big question mark. Is it sustainable? If it's for crypto, it hinges on the store of value thesis. So again, at least for crypto, again, very questionable, right? Is it far-reaching? Yes, of course. The entire world has currently demonstrated that this crypto wave is far-reaching from the west to the east. Everybody's trying to get into the crypto space, right? So just a couple of examples how you can assess your megatrends. Go back to your key principles and question them. Try to probe holes, try to research on um, expert analysis and opinions, etc. Right? And so another way of assessing your megatrend is to figure out one key principle of your megatrend, which is that it's a disruptor. Right? So you can start off with your company, figure out what industry it is, and then question whether or not is it in a traditional industry and is it trying to disrupt the traditional industry. So for example, if you have Tesla, you have the automobile industry, is it trying to compete using the same business model? No, definitely not, right? Because it's EV, it's electric vehicles, and so it's trying to disrupt that incumbent traditional industry. Is it not trying to, however, if that industry is trying to address a new market, for example, genomics or space or even AI, then it's not trying to disrupt an industry per se, but it's trying to create a market that will shift value from one industry to itself, right? So again, you're disrupting other people. So then try to figure out for your megatrend who's gonna get hurt, right? Disruptions will inevitably hurt your incumbents, and so figure out what it is and how strong this megatrend is in order to really disrupt your incumbent industries and your companies, right? And so again, megatrends threaten to replace incumbents or create new markets. And really, the key principle of this disruption is it shakes the established status quo. So you have technological advancements. You can have disruptions in the form of new market, establishing new markets, right? So one good example of this one is SpaceX and how it's trying to um, be the first in privatizing and democratizing space industry. Um, yeah. Okay. So in assessing your megatrends, also you have to figure out your inflection points. So mathematically, inflection points are your concave downward, concave upward reversal in trajectory for curves, right? So inflection points are when really sustained changes happen that a megatrend brings about, right? It starts to disrupt your incumbent industries, and it starts to, more importantly, it has to start accelerating into adoption. Um, an inflection point can be a fool's errand, figuring out the exact point in time where an inflection point started or happened might be a fool's errand. And to be honest, these things are more obvious after they've happened. And For me, at least for us, efforts are likely best focused towards whether or not you're still early in your megatrend. If you can establish the inflection point in the past, and then figure out if we're still early from that inflection point, or we're a bit too late, we're trying to catch up from other people who have already discovered this megatrend, that can give you a sense of how big a runway you still have for your company, right? So examples of which you have online retail. Online retail has been around for a long, long time. Amazon has been around for decades, but as you can see, an inflection point started around with COVID. This could be a renewal of that inflection point, a strengthening of an inflection point. But really, the more important thing here is to see that acceleration has been pulled forward, by COVID, and the shift to retail has really started to reaccelerate itself, right? Okay. Another example would be in DNA sequencing and genomics. This inflection point was brought about by Illumina, and Illumina is a DNA sequencing company that manufactures DNA sequencing devices. So previously, the the barrier to DNA sequencing being commercially available was really the exorbitant costs per genome to read DNA sequences, right? But Illumina was able to innovate and see how from the $1,000 per genome cost, usage has accelerated. How early is it from this inflection point? Um, I believe we're still very early in the DNA sequencing space, because this $1,000 inflection point is still being touted as the benchmark for future players in the DNA sequencing market as the hurdle rate for which commercialization for them will be reached. So they're all trying to reach that $1,000 point cost per genome level in order for their products to be actually cost efficient and economically viable for the market part customers that they have, right? And then this one is a latecomer. So now we have the number of fiber optics and internet cables added by year. And as you can see, we're pretty late already in in the internet infrastructure megatrend, right? It all started back in the early 90s, accelerated during the time of the dot-com bubble, boom bust. They were pretty early, but really from there on, acceleration continued to happen for for internet infrastructure, right? Okay. Any questions before we move on? None? Okay. So just a reminder, this is the life cycle of a company, and we try to focus fire ourselves here. Young growth, high growth, and mature growth, right? And even I want to highlight this particular area here, where even earnings, we're looking at companies that even earnings have not yet gone into the positive area yet. So that is of importance. Eventually, we'll discuss why. Um, um, yeah. Within this focus area, you will have varying levels of uncertainty. Really, for more mature, stable, for more later, later stage mature growth companies and mature stable companies, you will mostly have all of your information that's needed for you to have a lot of conviction on their performance versus here in this area where you have a lot more narratives that's very subjective to different people. So information uncertainty here, it could be higher. The degree of information uncertainty here could be higher, right? Okay, so now we're gonna try to establish the story of the companies. So we started with the megatrend, and now we're gonna try and figure out what the actual story is for the company. So pretty straightforward, right? You start off first with what the company is selling. Is it a product or a service? Is it trying to replace other products, or is it a never before seen product? What's more important, I think, is that you figure out what really is the value proposition of the company. And so the value proposition of the company will attract customers, right? It's the level of value add to the customer that will make the customer switch or buy that company's product or service. Um, doesn't matter if you've been able to um, create something new, but if the value add to the customer is net zero for that customer, it doesn't make sense for them to buy your product. So very important you try to establish the value proposition of your company. So another one would be to establish their monetization model. How do they make their sales and income? Really, right? So this is their essentially their what's their business model. And so monetization models can range from very simple to very complex. You have three companies here. Funko, I believe, I think everybody is familiar with Funko. They make toy figures from pop culture icons and characters, and then sell them for a profit. Pretty simple. Fiverr. Fiverr operates as a middleman for freelancers and people who are seeking outsourced labor. And so they operate a freelancer market, right? And so they take commission fees from both sides of the transaction, from the buyer and the seller. Okay, and then moving on to the more complex business model, we have Schrodinger, and they provide a computational platform for drug discovery, and their revenues can come from several different sources. They have licenses. They also have milestone payments for their drug discovery partnerships, and they also have drug discovery internal programs as well that they aim to develop for revenue generation in the future. So you have one simple level of buying, creating and then buying at and then selling at the margin. Then you have another level of operating a marketplace and earning commission fees, and then you have this much more complex level of complexity, sorry, in a business model, right? Where you have three possible revenue drivers for a single company. Okay. And so again, you're gonna have to refer to this image several times over the course of your research. Establishing the life cycle of a company really is very important because it can align your research more or less. If you're researching for numbers in a very young growth startup company, you're likely not going to be able to find any significant numbers for your company, right? But if you're trying to derive value from narratives from a more mature, more stable company, again, that's not that's not going to materially move the needle for your company because it's very transparent already on what the narrative is for that company, right? So it's going to be aligning your research, and one clue to this is really establishing the execution of your company. And if you refer back to Nell's presentation of the spark stages and commercial viability stages, excuse me, you'll be able to figure out that execution does not necessarily also that execution does not necessarily mean that the younger the company is, the more um, the more aged a company is, the more it has to move towards the right. Schrodinger, the one that I explained earlier, is actually a company that's already been in existence for 13 years, and yet their execution really is still here within the startup and young growth area, right? So it's not necessarily the age, but more on the execution of your company. So again, this is where you start merging narratives and numbers in different weights. Um, if you're at this point in time, how well is your company executing, right? Are they very established in the market already, in which they're participating in, or are they trying to just enter the market? Enter into the market. Do they already have a product? Are their products already standards in the market or in the industry, or is it just still under development? And so one clue that we look for initially in establishing the life cycle of a company, and where it is to initially look at the sales figures. And one key metric will be sales growth, and or actually the presence of sales in the first place. Okay, so again, let's look at Fiverr. It's a freelancer market that operates for that provides a more efficient manner of facilitating transactions between freelancers and outsource people who are looking for outsourced labor. They provide value-add services like escrow, um, transaction safety, customer ratings, buyer and seller ratings, etc. So it just makes the freelancer market much more fluid for both sides of the buyer and the seller, right? So it currently operates globally and shifting up market, and it earns commission from both, again, from both buyers and sellers on every successful transaction. So pretty straightforward. You have it's trying to what it is. What's the product? It's a freelancer market. The value add is it's giving a more efficient. It's providing a more efficient manner of facilitating transactions. And how it's monetizing itself. It earns commissions from both buyers and sellers, right? And so let's look at the numbers, and you'll be able to quickly see that it's operating at a high growth. You can see here the revenues, and the revenue grows year on year, 77, 90, and it's still projected to be upwards of more than 25% even by 2023. And these are consensus numbers. You'll be able to find them at the Bloomberg terminal. However, you can see here that their net income is still on the negative side. So again, if we're trying to establish where in the life cycle we are, you can see high growth here, and yet you can see your it's still not producing net income. It's still not profitable, right? So you're almost immediately you'll be able to figure that this company, is sure it's executing. You have sales, and you have growth in sales. You have high growth in sales, but um, profitability is not gonna come for like 2-3 years down the line. So you're in the young growth transitioning towards the high growth stage of the life cycle. And so researching this company, you'll be able to figure out that yes, it's still driven by narratives. It's still driven by what country it's gonna launch next, its freelancer market, etc. Or is the freelancer market gonna be really a sustainable thing? But at the same time, you have numbers to prove that it's already executing, right? So you're merging the two. You're trying to merge and balance out the two. Okay. Next example would be Luminar. It's a LiDAR hardware company. Uh, its products are still under development. It's trying to optimize it for series production, and it will eventually um, go towards series production by 2022. And so it's meant to be integrated in the cars of the future as for self-driving automated cars, for robotaxis, and um, even for trucks. And so currently it's under the last stages of its development, and several OEMs, the car manufacturers have already partnered with them and signed production contracts for the product. So it will be released by 2022. So immediately from this narrative, you'll see that um, there's no product yet. There's no series production product yet, right? It's still under development. Its sales are more likely not still going to be present because it's all partnerships and contracts for series productions. And the technology is very, very new. So LiDAR for automotive application it's still very much in its infancy right now. So if you look at the numbers, it's glaringly obvious. You have no sales. You really have little to no sales to be proud of for this company. But consensus estimates are touting that growth will come in the next 3 to 5 years. Right? You can see all the potential is down the line yet here. It's still not you're obviously not profitable yet, and uh you still have free cash flow negative. So it means the company is still burning cash. It's still trying to develop its R&D. It's still trying to develop its facilities, etc. So looking at numbers. If you're gonna try and figure out your conviction level for a company like this using numbers, is likely it's likely not going to be aligned with your research, right? Because everything, you're not going to be finding um, very how do we call this, convincing numbers early on for these companies. More of your research will naturally or should naturally gravitate towards the narrative for this company, right? The stories that it's touting, the potential of it, and all, or even the industry as well, right? Okay, moving on, we have Penn National Gaming. It operates land-based casinos. It has 41 gaming and racing properties across the country and different states, and it's got a new story for going on for itself. So it acquired Barstool Sports, and it signified its entrance into the online sports betting in the industry in the U.S., which was just recently federally legalized for the entire country, I believe 3 years ago. So you see that it's still a burgeoning market, and Penn National Gaming is trying to enter in that market as well. But from based on the net and the description alone, you'll be able to figure out that this is a more traditional company, land-based casinos. So really, a more mature company should be a more mature company, considering it also owns already 41 gaming properties, and it's just trying to develop a new growth story for itself by acquiring Barstool Sports, right? So if you look at the numbers, really very stable growth company, not even getting into double digit much. There's a jump here back in 2019. I believe this was because of some new properties that they acquired, but the consensus estimate is still going to be that it's still going to be a mature company. Now, what it's trying to develop right now is online sports betting with Barstool Sports, and so perhaps that will be enable them to develop a new growth trajectory for their revenues, right? But overall, they're still very much a mature company, right? So here you can see stable numbers, very mature company. So if you're trying to figure out whether or not it's executing, obviously it is, because of uh, because of its very stable numbers for its traditional business. The question becomes for this guy will be the potential for Barstool Sports and its online sports betting, right? Okay. And so it helps you align your research early on. You can vary the weights of the various data points you find. If you find numbers, are they much more important than the narratives or vice versa, right? So as we demonstrated, early companies will have not much numbers to show for yet and very stable numbers for more mature and mature companies, right? Okay. Next, we have to be able to establish the uncertainty in the company. Um, Again, we're trying to find pockets of uncertainty because we think these are where pockets of inefficiencies in the market can show itself. Again, the mindset of the analyst would be that generally you have a very efficient market, right? But it's not all the time that it presents itself. There will be pockets of inefficiencies in the market, and by focusing here in the young growth to high growth companies, we're trying to have that level of we're trying to create an advantage for us by participating in those higher levels of uncertainty. So the base case is, however, that because of the mindset, because of the general efficiency of the market, if you can understand the company is easily with just a few quick Google searches, then other people will also be able to understand that company as well, as easily as you can, right? So that's your base case. That's your base case, and really, the mindset here is that again, don't be fooled by thinking that have that you can easily build a unique information edge. Okay, so one tool that we try to use for figuring out whether or not there is a higher level of uncertainty or a lower level of uncertainty for a company is we see whether or not it's heavily covered already. So here in the Bloomberg analyst rating sheet page for a company. We have Penn National Gaming, what we discussed earlier. Very mature company, and so a lot of people already covering this stock, right? And so if you have a lot of eyes on a stock or on a company, you're more than likely to have little to no pockets of inefficiencies right now. However, because of that new growth story, again, that's one pocket of inefficiency that's come in new to this company, right? But generally speaking, without that, you have a very more often than not, or more than likely, you'll have a very efficient market for this company. Okay. You have fiber as well. You're looking at a higher growth company, but as you can see, not significantly lesser analysts trying to cover the company, right? So there's still much more uncertainty that can be seen for Fiverr. Yeah, and this is one tool that we have for establishing uncertainty. And then we move on. Let's try to figure out whether or not this one is a very well-known company, right? So Schrodinger is a biotech company. Actually a hybrid, more of a hybrid between computer science and a biotech company. It has developed a physics-based approach to modeling and predicting reactions and characteristics of different chemical molecules. It's trying to revolutionize the drug discovery space, and it's earning by licensing their products, as well as having milestone payments for drug discovery projects, and also have their own internal drug discovery program. So in your heads, try to figure out how many analysts do you think are covering this company. So you see, lesser than Fiverr. You have 7, and they're not even. You only have one, which is Morgan Stanley. That's probably the more heavyweight in the analysts and the companies and the analysts right now. So um, yeah, the more complicated, the higher uncertainty company you have, the lesser it can be easily understood. The likelihood of you having pockets of inefficiencies, and as you can see here, lesser eyes on it as well. Let's try to figure out the next one. So Bionanogenomics, it developed a product called the Sapphire, and its technology is called optical genome mapping technology, and it's touting that it can discover much more or much bigger structural variations in DNA. So structural variations are DNA mutations or permutations that happen that can develop that can result into genetic diseases and disorders. And so this company is trying to develop a way. This company is trying to market their product towards the more clinical application of things in order for people to understand better these structural variations in DNA. And so um, very new technology. DNA sequencing is already looking into this as well, but this guy is trying to disrupt something something that's still very young in its megatrend, right? So as we saw earlier, genomics is just early, and then this guy is trying to already uh, cement itself in that space. Um, so if you stack on one uncertainty after another, um, eventually you will have lesser eyes on it. So you see here for just 4 analysts trying to cover this stock. And so again, higher levels of uncertainty, definitely. You can confirm from this exercise that varying levels of visibility will also have varying levels of coverage as well. And it's one tool for us to figure out whether or not a company will have potential mispricing and and higher degrees of uncertainty, higher levels of uncertainty. Right. So again, right. When establishing uncertainty, it's also one way to find potentially mispriced stocks because they can be overlooked. However, because of market efficiency, more often than not, the overlooked stocks are overlooked for a reason. And so the onus is on you. It's really you have to be able to work through that inefficiency and through that uncertainty for you to be able to have a higher bar of conviction in to say that one stock is an overlooked stock or a company is an overlooked company, right? So it can be a tool to find mispriced companies to figure out whether or not a company is overlooked. But just remember that because of the key principles that we have, like market efficiency, um, they can be overlooked for a reason, right? So really have a higher standard for companies like this. Okay. Get creative in figuring out also how well your company is understood. So we saw earlier analysts covering the stock and figuring out that the more analysts covering a stock, the better it should be understood by the general market populace. But also try to figure out like through your other peers or through your team how well they can understand the company. So explain to them what the company is and try to gauge their level of understanding as to what the company is trying to do, what the value proposition is, etc. You can also look at forums, especially now in Reddit. You'll see a lot of people trying to get into the stock market, and you see a lot of analysts. Sorry, you see a lot of analysis from retail traders. Also, one source would be Seeking Alpha. I'm not sure if you guys have been familiarized with these sources, but um, Seeking Alpha is one source of information that we can look into to figure out whether or not a company is very well understood. People are welcome to post their analysis in that website, and so because of this, we can figure out a wider we can cast a wider net into whether or not a company is well understood, right? Also, if you're finding a lot of articles and also within these articles, are they aligned or not? If there is alignment between the information that you're finding, and if your information is generally pointing towards one way or another, uncertainty may not be as high, right? But if you have a mixed bag of data and you can't for certain figure out the general direction of understanding by the general market, then that's where you can find higher pockets of uncertainty. Okay, right. Sorry, excuse me. You also have other sources of uncertainty like the product and the technology itself. So, for example, LiDAR, sure, it's a very advanced technology, but will OEMs really largely adopt it? Or is Elon Musk going to be correct in saying that we only need cameras and a neural network in order to create fully self-driving technology, right? So that's a pocket of that's a pocket of uncertainty right there. Fuel cell technology, will this be enable us to transition towards clean energy, or is fuel cell technology going to be moot because everybody's just going to be running on their own solar cells, etc. Right? How about CRISPR, which is gene editing technology, right? It can cut paste genome base pairs essentially. And will that technology come to fruition as a new therapeutic uh, and replace the chemical-based drugs that we have? It's still, can you view the future for these guys? That's one pocket of uncertainty, right? Are you very certain that LiDAR is going to be adopted or fuel cell is going to be adopted, right? So new products and technologies will have that kind of uncertainty. So that's one way you can, that's one space you can figure out where you can find pockets of inefficiencies. Okay. You can also have inefficiencies in terms of the addressable market. Again, going back to LiDAR, you have peak sales for 100 million cars every year eventually, because they think analysts are thinking that new car sales will peak because everybody else will just find that ride sharing is more economical. And so they're envisioning a future of robo taxis and self-driving Ubers and whatnot, right? So how big is the market for LiDAR? Well, all these robo taxis and self-driving cars, can have at least one lidar, but how about robotaxis which need four lidars, right? So there's still a wide range of uncertainty for the market for lidar. How about marijuana? There are estimates that the US alone globally will be able to cover or will be able to top the market globally, right? Globally. However, there's still that very high uncertainty of whether or not the legal marijuana market can encroach on the illicit marijuana market, which they say varying levels of estimates from analysts and articles are saying that the illicit market is could be more than twice the legal market. What the legal market is envisioning for marijuana, at least in the US alone, right? So you can see how big of a range still there is for the market, for the potential addressable market for these companies. So that's one source of uncertainty. Also for the business model, you can going much more specifically to the company, a business model can be hard to understand or figure out how they're able to do it. So for example, here Fiverr, it's gaining two-way commissions, right, from the buyer and the seller. It's pretty straightforward. But if you compare it with the other peers, you'll see that it's leading its market versus like Upwork or freelancer or everybody else, right? And so how is it able to do this? That's one uncertainty that you'll be able to play around with and figure out the range of the possibilities, whether or not this will maintain its industry leading figures, accelerate further, demand further pricing power, or perhaps even on the negative side, be bumped lower because of competition, right? And another one would be regulation. So for DraftKings, it used to be a daily fantasy sports company, and now they've shifted towards online sports betting once the market was open in the US. However, even though it's federally legal in the US, sports betting is still going to have a state per state basis, right? Because of their federal system in the US, states are still allowed to develop their own laws. So the uncertainty here rides on how big potentially the market is for the US. Will all states in the market in the US open up to sports betting, or are we at our peak levels of market entrance right now? Okay, so again, you can you can try to gauge the range of its the uncertainty and the possibilities. Okay, any questions for move forward?
I have a question.
Yeah, sure.
What do you do if you have high conviction in a company's fundamentals and the fundamental factors haven't changed, but your technical analysis is telling you to sell? Do you hold it or do you sell it?
That depends on your trading goal. If you're Well, my easy answer would be if you're fundamentally biased, but your trading style isn't aligned to your bias, then immediately there's going to be a disconnect, right? So if I were to answer you, at least for a fund, we do use stop loss levels, price levels, but it's not necessarily that we give weight to every daily price move. Okay. It's a sign for us to perhaps reassess whether or not there is a fundamental change or shift in the narrative or a material change that happened. But uh, for us, it's still a multidisciplined approach, and it also depends on your trading goal. Right? If we want to hold through volatility, that's up. We If we want to hold through volatility because we are fundamentally convicted on a company, then we express that on our stop loss levels, and having a wider girth for the company for the price movement to move around. So yeah, it all depends on your trading goal.
Thank you.
Okay. Other questions?
When we're looking for mispricing and uh, when we're looking for mispriced companies, and since we're also looking at them from a we're looking for companies that are mispriced and also in the growth, rapid growth phase. How, like, at what point do we say na stop medyo, I think basura stock na to. I think we're getting close to the point na that this is a basura na and not just uh a growth stock. I think this is just garbage. Like, where do we make that call?
So what's your definition of basura stock? For you, what's your definition of a basura stock?
Um, yung, I guess that's true then. I don't have a proper definition for it. Perhaps it would be uh, that na quote unquote nilalaro siya na it's mostly a playground for traders and not really people who believe in what it's
Mm-hmm.
worth, perhaps.
If well, if you're saying na nilalaro siya, that means, would you agree that means it's still narrative driven, right?
Perhaps.
Kung hina-hype lang siya. Again,
Mm,
it all depends also on what you're trying to trade. If you're trying to trade basura stocks, that's not necessarily bad. But if you're trying to trade a basura stock like a high growth stock, then again, misalignment in goals, right? If you're fundamentally convicted on a stock and you're trading it like it's a basura stock, you'll likely be taking profits too soon. If you're trying to trade a high growth a basura stock, like a high growth stock, you'll likely be I know you'll likely be caught in a sharp sell off, right? So um it depends if you're trying to actually find more narrative driven companies or high growth companies. It's your preference whether or not sabihin mong masyado ng narrative to, hype na lang to, okay lang. I don't trade those types of stocks. I'm gonna try and focus on high growth stocks. Then that's perfectly fine. If you're saying that you wanna go for the stocks that move like 100, 200% in a week, then definitely go for the narrative driven stocks, like the hypeable ones. Like lahat kwento. Basura in terms of wala naman talagang produkto yan or wala naman talagang numbers yan. That's perfectly fine too. Sorry, did that answer your question? I know you're trying to delineate. I think you're trying to delineate between what's basura and not, but uh, it's a spectrum and also depends on what you want to trade.
that's okay. That was really helpful, Raman. Thank you.
Okay.
Yeah,
And okay. Hi.
yeah. I have one question now. So how long does it usually take to do these analysis? Kasi if it might take more than if it might take like a long time, maybe after you're done with the analysis, the stock price has moved too much na, or something.
Uh, it varies. For us, it varies. A deep dive analysis for our team can range between 3 days to several weeks sometimes. Because again, the research is always a work in progress, right? If for sure there are some moments in time when we're trading our investment fund and we see that the analysis needs to be done in like a few days because the price is starting to set up nicely for an entry and we want to figure out whether or not we want to be entering into this setup or into this particular point in time. So yeah, we try to ramp up our analysis, we try to ramp up our efforts in discussing, we try to focus fire our attention on it every meeting. But yeah, it depends on depends on whether or not you're in a rush to have a conclusion or you have time to have to develop your conclusion. Like if it's right now in a quite neglected, right? So depends.
Yeah. Uh, just one quick follow-up question. So have you ever done like a research and then it took, let's say, a little bit longer and then the stock price went up na, so you didn't buy it na lang kasi it was only attractive at that price level?
Definitely, it's happened to us before. But more often than not, because we consider the time horizon that we have, right? We have a 3 to 6 month time horizon for a fund. Um, those missed opportunities might have happened, but at the same time, if we think the mispricing runway is still far and the risk reward proportions are still in our favor, so it's again, if we still think that it hasn't gone up too far yet for us to be able to develop to garner good returns, we'll still be watching it. And if it set up nicely again, then that's the time we enter. So it's case to case. If it's already nearing the target price, then sorry, that's it. Then move on. Market's big. Move on to the next stock. Any other questions? Not? Okay, let's move on. Let's try to assess the moats for our companies. So one clue to assess the moats for your companies is if you're able to establish the business model of the company, then you'll be able to figure out what they're trying to aim for, right? So for Fiverr, if they're trying to acquire more customers and it's a market business model, you're pretty much seeing that it can be a network effect style of mode. However, the same can not be equally said for the likes of DraftKings. For DraftKings, it's more of a branding and customer stickiness type of mode, not necessarily a the more number of users, the more valuable it is. That's the network effect mode, right? That for DraftKings, there's still the possibility of people switching out of their network of from the DraftKings online sports betting platform and into, for say, example, FanDuel. But the thing is, if at least for their marketing survey, if they think that the market is that the customers are potentially sticky, meaning they stick to one brand for their online sports betting, then it's a different mode that they're trying to acquire. They're trying to acquire branding. They're trying to acquire a first mover advantage towards these customers. Um, yeah, so different strategies, but the same. So again, this will be give the clue here would be from the business model of their company. So yeah, and other sources of assessments for the moat is where they putting most of their spending power. Is our expenses going heavily toward R&D, so for technological advancements, marketing for again branding power and our customer acquisitions, or physical assets for higher barriers of entries and capex intensive modes. Are they patent heavy, which is a typical situation for your leading for technology highly advanced technological companies, like for example lidar. A lot of these companies will have a lot of patents, right? Or even towards the nature of the industry. What's the incumbent leaders trying to develop or have developed as their mode, right? If you're able to figure out what the mode of the leaders are, then you can try to figure out what your company is trying to achieve as well. So it may be trying to weaken the mode of their incumbents, or it may be trying to develop a different type of mode from the incumbents. Okay. So these are just some of the sample questions that you can figure out, that you can ask as a starting point for assessments of your modes. But one key question here is to answer is really how hard is it to replicate, right? So it's a very tough question to answer, and it pretty much means that you have to look at your competition. It doesn't mean that you're studying one company, you're just studying one company all the time. With the deep dive analysis, once you're in it, you're going to have to do competitive analysis. And competitive analysis means that you're not just studying one company, you're studying three or more, four more, right? In the industry. You're going to try and do initial assessments on how strong the moats are for, or how strong the competition is. And if competition is strong, then the moat may not be as strong for a company. If the competition is trying to catch up and still cannot do it, then probably the moat for a company is stronger, right? So for example, here, technological advantage, we have Pacific Biosciences, so PACB. It's it developed a long read sequencer, DNA sequencer, right, for sequencing, DNA sequencing. Sorry. It's highly accurate. It's the only long read DNA sequencer out there that can do 99.9% accuracy in terms of DNA sequences. It's patent protected, of course. However, the clue here for technological leadership is that Illumina, so the Illumina, the company that brought about the inflection point for DNA sequencing, tried to acquire this company, right? Illumina is specializing in short read sequencers. By that, I mean, Illumina sequencers can read up to around 100, 1,000 base pairs of DNA. So base pair meaning GACT base pairs for DNAs. So their sequencers can only do 1,000, while Pacific Biosciences can do more, upwards to 20,000 base pairs reads. So very longer DNA reads, highly accurate DNA reads, and it's something that Illumina wanted to buy. They were only thwarted by anti-monopolistic concerns and laws. They were thwarted, and they didn't. The merger did not go through. Until now, Illumina has not yet been able to come up with a product that was supposed to be the long-read sequencer of PACB. So that's a clue for technological leadership. Or is competition, even the biggest guy in the field, if even the biggest guy in the field cannot replicate your product, then you have something, right? So again, competitive analysis. You have to figure out what the others are doing. Right? Fiverr, is the network effect successful? You have a market. You have a market that goes in value because excuse me, sorry. The more participants you have in the market, the more attractive it is to other participants. And so you can see here, active buyers are growing very high, very fast. 2.3 million from 2019 full year, estimated to go upwards to 5 million by 2022, right? A, a big leap between the between 2019 and 2022. Its closest competitor in terms of the nature of what it's doing is Upwork. And Upwork for the full year 2019, at least from my initial look, has only around 600,000 clients. It's trying, it's growing, its core client, but really, can it catch up to 2.3 million to 5 million? Again, Fiverr is doing something very well to develop and further strengthen their moat, right? So again, you can only have this conviction if you look at your competitors. It's easy for me to say a company has moat, sure, but how strong is this? You cannot have a level of objectivity to say how strong or weak a moat is without looking at others. Okay, so it's necessary for you to look into the other companies. Other examples would be capex intensive businesses. So this headline just came out a few hours ago or yesterday, right? Yesterday, Lordstown Motors, one startup company that's trying to develop, I believe, electric vehicles or EV trucks as well, admitted that it does not have enough cash to start commercial production. So how will it compete against the likes of Tesla? Or how will it compete against the likes of Ford that just came out with its Lightning truck, right? If it doesn't have enough cash. So a capex intensive business will have that natural moat for them, right? So all the physical assets that they need to invest on to be able to produce at a commercial level for all these cars, that's going to be hard to replicate, right? You also have regulatory limitations. One source of uncertainty has now become also a source of moat. The strength of the moat for regulatory limitations, like for example, drafting and pen, you have a limited number of gambling licenses per state and per operator. If DraftKings and pen are already able to enter into a state, then that's good enough for them, right? It's already a strong enough first mover competitive advantage that other players might not be able to get into that state because simply there's a limited number of licenses, gambling licenses. So yeah, you can of course read up on a lot more variations of moats, but again, this is just an example of how how important really competitive analysis after establishing what the is for a company and what it's trying to do, you have to figure out how strong it is, and that can only be done by really looking at your competitors and looking at the environment as well. And so you probe the strength of your moat after you establish it, right? Think like a competitor and think how easy it is would it be for me as a competitor to build an alternative. Is it going to be easy for me to build another Funko toy and just for people to collect my Funko toys as well, right? This is the problem of commoditization. And if your products are easily going to be commoditized, then you might not have a moat in the first place. Excuse me. For the situation of Fiverr and Upwork earlier, right? How hard would it be for Upwork to catch up with Fiverr in terms of the number of active buyers it has? It has sub 1 million active buyers and it's growing not as fast. Um, will it be able to catch up really, or will it just be second place or third place from Fiverr? Um, Again, you have to try and assess all these with along with all the other data points that you're able to gather, right? So if you think that Upwork will be able to catch up with Fiverr, then you have to prove it by, for example, looking at articles and customer and buyer reviews and saying that Upwork is still building up its own market and it will accelerate further because it will go in towards more enterprise level customers, right? For offices that might want to offload certain work processes. Maybe Upwork's market's there. Again, you have to figure out your competition and what they're trying to do, and also figure out if they're going to be able to do it. Um, yeah, there's no shortcut. The problem, however, with competitive advantage analysis and competitive analysis is, at least for our purposes, is that if you're focusing on high growth and young companies, right, these may not show itself in the numbers as early as you may think they would. So the problem is, especially for the question earlier from Kobe, whether it's too narrative driven, definitely no numbers yet. So a lot of your assessments might deal with potential. Will they be market leader? Can they be leading in margins or revenue growth? Will they remain competitive as they stabilize as a company? So um, yeah, a lot of introspection will be needed for trying to assess potential, um, especially if you don't have the numbers yet that can back it up, right? So maybe your moat assessment will be also more narrative driven rather than numbers driven. Okay. Right. Any questions before we move on? Okay. None? Okay. Let's go towards perception in the pricing game. You've been given this infographic in one form or another, but essentially it's a way of visualizing what Benjamin Graham has said, which is in the short run the market is a voting machine, and the long run it's a weighing machine. Right? Eventually your price will merge towards earnings power and earnings growth, but in the short run it will fluctuate around that figure, and that fluctuation is brought about by the gap that we saw earlier, right, between value and price. There will be a gap inevitably, and this is brought about by the uncertainties that we find, the pockets of inefficiencies that we find, and of course, the goal is, will it close, right? If you're finding a mispricing, the next thing you have to figure out is, will it close? Because other than that, you'll be stuck in a company that won't move, right? So because we play the pricing game, inevitably your research will have to delineate towards what I call internal and external research. Internal research is what we've been discussing earlier, like the product, the value add, your business model, what's a competitive advantage, right? And then another one would be external research. And so you're gonna have to try and figure out what other people think about the company. You may be thinking your company's the best in the business. No other competitor can fight against them. And then you have to prove that also by checking out what others think about your company. Are broker reports saying the same, or are they saying otherwise? Are customers actually thinking that the product is crap, or actually also think that the product is the best there is in the business, right? So internal and external research. You have to figure out what the market is also thinking about your company rather than not just you. Okay. And so one way of looking into perception is again going back into uncertainty and also into execution risk. If your company, like for example, the two you have here, which is Ring Central and Intuitive Surgical, um, you're pretty much already in the bank, right? So execution risk for these guys is very low. Then we know they're already market leading. They've already been in the industry in their respective industries for a very long time. They're already incumbents. So naturally, what the market would think about these guys is that they're very good businesses. They're very stable, right? But if you're going towards more speculative, towards this more speculative range of the life cycle of company, for example, for DraftKings and PacB, for example. These guys, sure, they have a product, sure, they're doing well, but there's still some uncertainty with them. Will DraftKings be the market leader, right? It's still trying to acquire a lot of customers. It's still competing against FanDuel. It might be competing against a lot of other outsiders from from other countries going into the US because of the huge market potential of its online sports betting, etc. So naturally, the market will discount these guys because they still have a bit more risk inherent with them. Okay, and then again, going to the more extreme parts of the spectrum is if you still have no product set or your sales are still towards the future and all potential and all you're touting are stories, right? And so naturally, the market might perceive you as a very risky company and might not think too much of you. Um, yet until the company executes, right? So yeah, it in that's what we call the risking. If your company starts to execute and execute well, the risks of the company being a short-lived entity is getting lower, and so the market will naturally try to figure you out more, and perhaps maybe upgrade their ratings on you. Okay, and so once you're able to flesh out those risks, you'll be able to also figure out what will move the needle for the market. If it's a risky execution, then you're gonna be the potential catalyst for it would be better execution. If you are in a risky market, like for example, in a regulatory market that's highly uncertain whether or not the future is bright or not, then the driver for that would be regulatory improvements. So once you figure out those risks, you'll be able to figure out what the key drivers would be. Right? So let's go over some examples. This is MJ, and this is the ETF for marijuana stocks in the US. And so the catalyst for that up move really is uh, the Georgia runoff elections back in early 2020, January, early January 2021, wherein Democrats won a majority seat in the Senate. It has been a Republican-led Senate for a long time, and for the Biden administration, it became a Democratic majority Senate, and this has been a long-standing issue for marijuana regulation in the U.S. because Republicans are into of are adamant to blocking the regulations for marijuana to be federally legal. And so once that hurdle was reached, once the results were out that it will be a Democratic Senate, gap up price, right? So you're in a regulatory risky environment. Something happened in the regulatory environment that might push the needle towards better regulation for marijuana or federally legalizing marijuana eventually. price gap. Pack B, again, Pacific Biosciences. So for a long time, their product was good, but also just focused on the academe. So their core market was just academic researchers, universities, perhaps small laboratories, etc. But when the new CEO came in from Illumina, who was in charge of Illumina's commercialization efforts back when they were the ones trying to revolutionize the DNA sequencing market, the market participants immediately thought of it as PACB shifting towards commercialization and greater marketing of their already good product. And so, that catalyst moved the needle for the company, and there you go, price rally. Okay, I'm gonna introduce Fastly, which is a CDN, and it's essentially it's trying to disrupt the traditional model of internet infrastructures for CDNs. And CDNs are servers that are placed locally nearer towards customers so that content can be delivered faster. And so this is the difference why some websites may be able to load faster than other websites, because perhaps some websites are hosted closer towards you, or some are hosted farther. And so the goal of the CDN is to have a lot of these points of presence, right? But Fastly is trying to disrupt that by being um, strategic in their points of presence, and locating themselves in higher internet traffic networks, right? So what happened? First, earnings results beat consensus. So here we have an example of a company's market perception needle moving because of one, de-risking, and two, execution getting favorably better. And then the internet infrastructure boom could have been also brought about by COVID because of all the need for internet, right? Work from home, e-commerce, etc. So the earnings release was better than what the market expected, and even better than what our full year model was expecting for this company. And that was just the first quarter. Um, yeah, that was just for one quarter at least. And it's not yet for the full year. And so that signaled to the market and also for us that execution is going to ramp up for this guy. And then another news came about, which is that they released an earnings preview, and where they disclosed that ByteDance was one of their biggest customers. And so ByteDance being TikTok essentially, and being banned in the US because of Trump's anti-China agenda. If you are a company whose revenues are overly reliant um, on one major customer, and that major customer suddenly falls out, then um, a catalyst for the downside. Okay, so yeah, perception. Any questions before we move on? Your rating is highly connected to this as well, so we can continue if you guys have no more questions.
So actually, this one is this one's actually related to the homework that's actually due today.
Okay,
Uh, since we're on
nauunahan na
topic
kayo
na,
guys.
nauna nga sila mag-submit eh. So, ayun.
Mm,
Ayun. On the topic of yung, the narrative and the ratings, like when we try to make a report on the narrative, on what we think of the narrative of the company is, uh, do we focus more on the like the upside na oh ito yung mga ginagawa niya, ito yung mga potential niya, or should we also include perhaps na ito yung mga risks naman niya na as you said nga uh, one of its major investors happens to be a unfortunately a China entity, so its
mm,
stock got ravaged.
mm,
So when we make our Like when we make a report, perhaps for outside for outside use, like in the homework that we make, do we focus more on the, oh, here's what this company does, or should we also consider now, oh, because of its relation to this company, baka medyo sketch tayo dito.
Definitely. Because again, this is a deep dive analysis, is a holistic, you're trying to develop a holistic view of your company. If you're ignoring the risks, and the risks are actually have higher odds of happening, or higher chances of happening than more than what you thought of previously, then that might have a material effect on what your out an overall conclusion would be, right? So as I said earlier, it's a balancing act. And if you weigh that the negatives or the risks inherent in your company are actually much heavier than, I guess, your how than what you're comfortable with in terms of risk, then definitely you should include it. You should uh it's um it's a principle of having um uh weights on everything that you can know. And there are known knowns and known unknowns. There are things that you can't have an answer to, and you have to figure out whether or not that makes it riskier or less, or probably not. And unfortunately, there are unknown unknowns. For example, in Fastly, we did not know that ByteDance was actually a client for Fastly. We were holding it, and then we were able to sell half on that surge before the gap down happened. And it was for us a unknown unknown. We did not know that ByteDance was actually a client. And um yeah, it's just the nature of the game, I guess. But if you are able to figure out that that actually is a risk for your company, then yes, you definitely have to include it, especially if you think it's a material risk.
Thank you.
Okay, right. Let's go to re-rating. So it's a process by which your stock gets upgraded or downgraded by the market, right? So we search for mispriced stocks. We figure out whether or not there are pockets of inefficiencies around that stock because of uncertainties, and this should tie your this should tie your research together, right? We connect a catalyst that would close the gap between the value and the price. And so that catalyst will enable the re-rating to happen. So just before we move on, let's have a primer on relative valuations. And relative valuations, as opposed to absolute valuations, is there are material differences between the two, right? And so relative valuations are your price multiples, are the tools for the price in the earlier image from Aswat Damodaran, and absolute valuations are your intrinsic value calculations. So you project your future cash flows or earnings, and then you figure out a discount rate for them, and then that's your intrinsic value, right? Versus relative valuations, which use price metrics. So let's just breeze through it. You have two stocks which are similarly priced in terms of market cap, right? You have 10 billion both sides. So using a single metric of price, you will not be able to figure out which one's better or worse. Okay. So to facilitate the comparison between the two, we add another metric, which is, for this example, net income. If you have net income, you'll be able to figure out earnings per share. You simply divide your net income by the number of shares outstanding you have. For the sake of comparison, we put them as equal between the two. And so you see here that the earnings per share of company B is actually higher than company A. And yet, if you were only to compare it between the two as price, you'd be overpaying for company A, and you would be underpaying for company B in that regard, because again, relative valuation means you have to compare between the two. So yeah, that's a basic relative valuation use, and you will be able to find other relative valuation multiples as you go along with your research, and especially other brokers, other security analysts will devise other pricing multiples as well. You will find like gross gross margin multiples, net sales multiples, and whatnot. Sometimes analysts can get creative in what multiples they're trying to use for comparison. But mainly for our research, we use price to sales. Why? Because some of our companies are not yet earning. And so if you use PE ratios, price to earnings ratios, that's counterintuitive, right? So we use price to sales as a gauge of what the market is trying to rate it at. Okay, and so when we say re-rating, if you break down the sources of price or re-rating for that matter, you can either go towards price over earnings per share or price over sales per share, right? And so the PE and PS ratios, you could think of this as the vote of the market. So the market's current vote on the company can be discerned by looking at what its PE or PS ratios are currently. Okay, and so all else equal, if market participants think um, a company deserves a better rating than before, all else equal, even without earnings per share or sales per share moving, they can upgrade it using PE or PS as somehow as a basis of upgrading, right? All else equal. Another would be if all else equal, the market's rating does not move, and yet it's growing on earnings and it's growing in sales per share, then definitely price will move as well accordingly, right? And so the two main sources for rating will be the market's perception and the inherent growth of the company. Okay, and visually, this is what we're trying to figure out, right? Whether there's a mispricing, and two, whether or not that mispricing can close. And visually, that mispricing closes the gap between value and price by virtue of re-rating some. And so, one, we try to figure out where in its peers, amongst its peers, is the company located in? Is it below the average, near the leader of the pack, or near the average, etc. And then we figure out through it by virtue of its uncertainty whether or not the market is actually pricing it incorrectly. If we have a certain level of conviction that we think the market is wrong, and again, this has to be a high level of conviction, as much as you can actually, to say that the market is wrong about a company, then that's where potential mispricing happens, and the catalyst would inevitably could move your rating from left to right. Okay? So this is where the culmination of your research, your fundamental analysis, your competitive analysis, your perception analysis um, should flow towards. Okay? So again, the importance of catalysts. Without catalysts, sometimes it will not get noticed. Okay, it has to get noticed. Like for example, the catalysts that we had earlier was Fastly's earnings, PacB's new CEO, and we had um sorry, I forgot the word. Forgot the word. But yeah, there's a catalyst that should happen, and that should drive the closing of the gap. Okay, and that catalyst inevitably should flow whether or not to a better perception on the company or towards better growth for the company. Okay. Okay. So here we have some examples of re-ratings, right? Again, we're going to be using PacB. PacB's new CEO was announced here, and then that announcement flowed towards initially market perception. And so the company moving towards larger markets gave the market impetus to re-rate this company from 5 times PS to just yeah, the leader of the pack essentially, right? Why? Because market thinks it's a very good product, but at the same time it's containing itself in a small market. And so if you're containing yourself in a small market, your chances of growing your chances of growing is naturally limited. If your new leadership is going to be taking you towards bigger markets, then that's a change in perception of the market for the company, right? All of a sudden, the market will think, oh, maybe growth will come into the company, right? And eventually, yes, the process of re-rating did happen. The company started exhibiting better sales, and earnings results got released further down the line, right? We have Fiverr, whose catalysts was earnings beating expectations by the market, and even though JP Morgan was already covering the stock here, their price target was actually still quite low, I think around the 37 area during these times. And so the market started re-rating the stock as execution got better. Further down the line, execution got better. Analysts continued upgrading the stock. Um, and also, um, COVID was also a natural boon for the company. COVID being the catalyst for a lot of internet-driven growth stories, right? And so for Fiverr, it's more on the remote work, the availability of freelancers all around the globe because of the internet, etc. And so again, even though during that time, back in for the year ending, for January 2020, it's already near the leadership market levels for price to sales rating. It further got bumped, right? Okay, and then lastly would be Penn National. So again, mature company. So we're using PE ratings for this guy because it is an industry where incumbents should be profitable, right? So PEs are in my opinion was better suited for the comparisons. And so the new story was Barstool Sports, and this introduced a new pocket and a new aspect of uncertainty for this company. And so when that story came about, even though growth in the sales for this company has yet to be proven to be successful in terms of their entry into the sports betting arena, right? Um, the market perception of the company went from maybe this is just a mature stock, it won't grow anymore, towards maybe now it's gotten something new. It's got something of a potential here that can grow further, right? So even though sales did not really materially grow, especially since it got hit from COVID, um, and I believe their sports betting app was recently just launched early this year. And so material growth will not yet happen for that guy. The market perception for Penn from a mature company to perhaps another growth story for the company re-rated the stock. Okay, so those are examples of re-rating. And so before we move on to the advanced tool, any questions on re-rating? Yeah, any questions on re-rating? None? Okay. And so I'm going to introduce to you a pseudo DCF model, what I think is a pseudo DCF model, which is a tool we use for our analysis as well, for deep dive analysis. So the 5-year valuation model serves for us several purposes, right? It helps us in figuring out whether there is a mispricing. It can help us to figure out whether there is a mispricing. It helps us to figure out what's currently priced in for the company, and also a tool to gauge how wide the ranges could be for the company. Excuse me. And then it also serves as a tool of which we can apply certain back of the envelope modelings that we can do for the company. Okay. So steps in the valuation model. First off, we try to project sales up to 5 years. And so the sources of the growth rates can be from TAM projections to even company guidances, and even looking at analysts' projections for the company. Um, we can apply, after which we apply a margin figure on the future sales so that we can obtain a net income figure for the future. And so the challenge here would be figuring out the acceptable margin figure for a company, especially if your company still isn't profitable. Therefore, you won't have any historical data on how you can estimate your margin figures, right? So challenge here would be figuring out whether or not there are comparables for the company, whether there are peers or there are market incumbent leaders in the space, and to assess if what you're envisioning for the company is close to or even exceeds what those incumbents are right now. So, for example, if I'm looking at Fiverr, and I think that they will be market leaders in their industry, and so I will naturally go and figure out whether there is a company that closely resembles its business model. So it's a marketplace, right? So we can look into, for example, the examples there were Etsy. Also, but you have to be able to find a company that's also doing more of a stable business already, so that you have a net margin figure that you can apply, right? And so the challenge again is finding peers. Eventually, inevitably, it is finding peers, especially for highly technological, complex companies whose peers may not even have shown up yet in the industry, right? Okay. After you apply a net margin figure to come up with a net income figure, you apply a PE ratio. So you multiply that that net income figure by PE ratio in order to come up with the future market cap. And that market cap we try to discount towards the present using time value of money principles, so DCFs, discounted figures, sorry. And then we compare that discounted present value future market cap towards the current market cap of the company. Okay. Um, so yeah, those are the steps. And so word of caution though, before you attempt doing a projection for your company, any projection for that matter, is garbage in, garbage out, right? Quality of your projections will only be as good as the quality of your inputs. If you cannot vet properly your inputs, please try and hesitate before using them. As much as you can, you have to be certain of your inputs. You have to try and vet that they come from respectable sources like industry experts. And so that's why we try and sometimes we do use broker reports for our projections sometimes, because we know that those brokers are again more well resourced and have much more connections in the industry that we do, and so their projections are more than likely to be coming from good sources, right? So again, vet your inputs and notice the number of inputs that you have to plug in as estimates. And so the more and more errors you plug in, the more wider the margin of errors you allow yourself for your inputs, the higher the margin of errors you will inevitably have on your projections. And you only need a small difference of magnitude between input and actual before your projections get widely off target. Okay. Again, so be very careful in be very careful in using market inputs. Try to discern your inputs. Try to capture more than one data point for a projection. So for example, growth rates, don't just go for one broker, go for five, go for all the broker reports you can see. And then align that with also whether or not you can figure out market growth rates and see if those broker reports align versus what other analysts are saying is for the markets. And yeah, um, because to it's easy to input um, small adjustments here and and consider them as, well, they're just small adjustments. What harm can it be? But if you project them towards the future, they can have a huge impact between what your projection is and what the actual would happen, right? So let's see an example of a 5-year valuation model. So this is Luminar, the LiDAR company earlier. Um, First step would be to project your sales towards the future. And so for what I did here was to have a market cap figure, right? The future market cap figure that when discounted towards the present using a 12% discount rate will closely resemble towards zero upside, right? 1% zero to one zero upside essentially, right? And so this is where I can figure out what the market is trying to price in right now, what the market is trying to project in using for this company, right? So this model is telling me that if I play around with the figures, um, it could be that the market could be projecting a hyper growth for the rest of 5 years. So this is a compounded annual growth rate. Um, it's telling me that it's gonna gain high levels of terminal net margins. Um, and yeah, so now your research has to bear fruit on whether or not you think these rates are actually doable. Are these figures, like your revenue growth rate, for example, actually aligned with your, for example, your broker reports or the addressable market growth rate that you're finding in your research figures, right? If this guy is growing at 117% per year for the next 5 years and your market is growing at 30, right? There could be a disconnect, or there could be just that Luminar is highly going to be slated as the leader in that market, right? So again, you try to figure out whether or not this is realistic in a sense. So this is more often than not how I use the 5-year valuation model. Not necessarily as a tool for getting a target price, more so, but to figure out whether or not my research is actually saying something otherwise than what the market is saying. And what the market is saying for this guy is that it's going to grow at hyper growth levels. Okay. And also, if you extend the tool and try to break it down for evaluation for your business modeling, so you can see that for Luminar, you can figure out what the key drivers are for its growth. So you have the number of vehicles in the future, how many cars of those will have higher levels of autonomous driving features, and how much of that market share will, how much of that higher level ADAS cars will have Luminar, so that's the market share, and then how many LiDAR systems per vehicle. As you can see how many things you have to estimate and how things can easily be, and how your projection can easily range far and wide between upside and downside, right? Because the number of inputs that you have to estimate is a lot. And so if you try to do a back of the envelope projection, if we try to equate what the market is trying to project right now, so you try to play around with the numbers and equate future sales with what you projected earlier. So we had 1.3 billion, 1.34 billion. So I tried to get as close to that figure. Considering all the research that I did for the company, I know that the company is imagining a future where passenger vehicles have only one LiDAR system per vehicle, trucks will have at least three, robotaxis will at least have four, and then I input a broker report figure for the vehicle breakdowns here from Deutsche, I believe, yeah, from Deutsche, and say that, and they envision a future wherein future sales of cars will be 98% passenger vehicles, 1.5% trucks, and 0.5% for robotaxis. And so, and you have research telling you that vehicle sales will peak at 100 million per year. And so the rest will be trying to project whether or not how many, if you can figure out a research figure, from your research, a figure for how many vehicles will have higher levels of autonomy in the future. So here, 25%. And then now it's figuring out whether or not, and then trying to input a matching market share that can come up to 1.3 billion, as close to the as possible to your 1.34 billion projected sales earlier. And so you're saying here that if you break down that sales figure, they're saying that with a 100 million vehicle market, Luminar will have 11% market share and at an average selling price of 500, which is also a projection mostly in the industry of what the standard price would have to be before commercialization really sets in. And so if the point of contention would be market share, all of your research will have to figure out, is this appropriate for Luminar? Am I saying that Luminar would just have subpar market shares? And so 11% is realistic. It's okay. Therefore, it's already priced in. Or am I saying that, or is the research actually pointing towards Luminar being the market leader? And so 11% might be conservative, right? And so we try to adjust for this and see how much upside we can for what, 15% or 20% and figure out how much the range between that is. Okay. Also, if your research points out to the downside and that Luminar is not, after all the readings that you have found, and that you say that Luminar will just be an average market player, then 11% might be too big actually. And then it's 5% or 6, 7% only. And then you have lower sales, and then you figure out that maybe you're gonna be overpaying for Luminar. So yeah, and that's it. Any and so again, to culminate everything, deep dive analysis will always take time. To answer the question earlier, it will take time. Also depends on, but sure, since we are a multidisciplinary team and we also follow price, sometimes we have to push forward some into priority, some deep dive analysis. But again, generally speaking, if you're doing a deep dive analysis, it will take time, but it's needed in order to obtain higher conviction levels, right? We try to poke holes in ideas, we try to debate, we try to figure out that the idea really is strong or weak. And so for us in the team, it's natural to have continuous back and forth questioning discussions. And yeah, you have to get used to your ideas getting attacked. And so we aim to be truth seekers as a whole, right? It's still hard to find mispriced stocks, but if you're able to do your research well and you're able to capture them, have finding mispriced stocks and truly mispriced stocks can define your returns. And ultimately, knowing the right questions in every aspect that we discussed earlier, knowing the right questions to ask, what the right questions to ask, is a very important skill. But at the same time, it's a skill that you will have to just learn through experience by looking at a lot of companies and developing a lot of your mental models of different companies that you cover. Okay. Sorry, we don't. Just 2 minutes left for Q&A, but just shoot. If you have any other questions.
Hi Tim. I'll start us off. So actually, we have a question from the Facebook stream. This was
Okay.
from Neil. Sorry if I butchered your name. I'm not sure how to fully pronounce this. But his question was based on one of your earlier topics, and this was: does the complexity of a company's monetization model matter? Is it a significant factor, or would it be fine as long as the company is profitable when investing?
Um, it's a significant factor in terms of finding pockets of uncertainty. If you have a complex monetization model, like for example, Schrodinger's three-tier or three key drivers of potential revenue, you will have to figure out which of those key drivers will actually really matter in the future, right? Versus Funko, which is toy sales. You figure out how much toys Funko can sell and then that's your key driver. But for complex business models like for Schrodinger, you have higher levels of uncertainty in the future because you don't know which one of those revenue drivers will actually pan out. So it sure in the long term it doesn't matter, because if a company is continuing to be profitable, what that business model is will that will work should not in, matter anymore, I guess, if you're investing. But for us, because we're trying to figure out what the mispricing is and where the uncertainty is coming from and whether or not that gap will close, it's it's important for us to figure out that monetization model as well, and to figure out which one would pan out, because we need to know what would be the key driver in the future is. Yeah, that's it. Hope that answers this question.
Guys, go ahead, ask your questions. Don't be shy. We can go a little bit over time if it's okay with you, Tim.
Yeah, sure. You guys, a few minutes. It's okay. If anybody, especially you guys, I know you guys have an assignment or a presentation to boss. So if you have questions on your research, maybe I can try and poke holes at them.
I guess I do have a bit one that may be a bit applicable for the guys who are also working on their homeworks. Suppose we have companies that are experiencing 100% or close to 100% growth. How do we project that into the future? Like, parang it's a bit unlikely. I don't think it's quite likely that that a company can experience
Mm.
multiple consecutive years of 100% plus growth.
Yeah, that's a very good question. And actually, earlier I demonstrated a 5-year valuation model, right? But it's not the end all be all. That 5-year valuation model, actually we can project to a 10-year valuation model. And so that 100% per year KGAR definitely and good instincts right there definitely is, wow, highly unlikely. It could be a highly unlikely figure, right? But if you want, if that's the case, and and you think that hypergrowth, a continuous hypergrowth, is not doable for an extended period of time for your company, you may want to normalize it by extending your time frame. And actually, if you look at the broker reports for Luminar, they've actually done that as well. And for illustration purposes, I presented to you a 5-year model, but really what others are doing and what we tried to do as well is to project growth over 10 years, because we do know that from our research, it's still early for LiDAR and for autonomous vehicles. We know that the peak of the market will not be in 2025. It's likely to be 2030-ish, around that figure. And so you project that as well towards your valuation model, towards your 5-year projection. You extend it towards, say, a 10-year projection model, in the hopes of you having a more normalized runway, right? But yeah, that's one way we try and normalize hypergrowth rates that seem highly implausible, right?
And also, if I may ask now another a question that just sort of occurred to me lang. Uh, like, this a bit on a previous topic pa, but like what when a company is for instance acquired, or like when a big when a big investor or a company that wants to acquire it perhaps acquires a significant stake, would that be cause uh for a reevaluation? Like in your
Hmm.
experience, do acquisitions uh have significant effects on future performance?
Okay, I'm gonna assume that you're saying a significant stake does not mean that it's a full-on merger, right?
Either
And that
fully acquired or quite significant stake,
uh
like board seat
and
perhaps or two.
you're asking for the performance of the acquirer or the one that
Uh,
was acquired.
the one that was acquired, like
Okay.
kunwari growth siya, tapos in-acquire
Uh
siya.
Okay. One example of it, like it depends on what type of investor actually got into that merger in the first place. One example is CGC, Canopy Growth. Previously, during the marijuana phase, CGC was acquired by um, I forgot the name of the company, but it's a beverage company. It's a alcoholic beverage company, and so the market, I believe it was InBev, and so the market re-rated CGC for quite a bit because the perception there was that that beverage company, that alcoholic company, was going to impart its expertise in well, I guess there's no other word for it, but sin products, right? Um, and they're gonna impart their expertise towards the growth of this new marijuana industry. And so for CGC, it was a good thing getting for them selling a significant stake on a mature guy that knows how to, I guess, play these types of markets or fields, right? So that's a good one for them. If and so I guess the point of the example is if there's alignment between the acquirer and the acquiree, and it's not just a random acquisition of someone trying to just, I guess, expand and diversify their business portfolio, then perhaps it may move the needle for that company, right? If there's a alignment between the two. Sometimes you call that like if there's a significant backer for the company, right? So yeah, it depends on the situation, and so again, you're gonna have to analyze not just one company but the other company as well, and figure out its motives for acquiring your company or a significant stake for a company.
Thank you.
Sure. Anyone else? Okay. I guess no more questions.
No more questions, guys. Anyone want a final word or anything? Okay. Let's wrap it up there if no one has anything else to say. So again, thank you so much, Tim, for your time today. And oh, we have one more question from
Oh,
Harold
okay.
or
Oh yeah.
okay.
Okay.
Okay, so thank you again, Tim, for your time today, and thank you for everyone for attending today's live session. So this officially concludes our first week of the boot camp. We hope you guys have enjoyed the experience so far and are learning a lot at the same time. So for now, you guys can take a break this weekend to re-energize for more fun activities and content we prepared for you guys in the upcoming weeks to come. So our next session will be on Monday, June 14, with Chairman Edward Lee at 10 a.m., followed by Edmund Lee at 2 p.m., who will be giving a lesson on valuation. So stay safe, everyone. Happy weekend, and we look forward to seeing you guys there.
Interns. So the snapshot homework would the submission is today. Then you have a new homework is to start a deep dive for a company that you like the most among the three snapshots you did. The deadline will be on Tuesday, and then you upload it na lang sa Drive. So on Monday for chairman, um, we won't know how many, but he will just randomly call any of you guys, and you should present the one snapshot that you are deep diving into. So yung favorite company mo. Yun lang, heads up lang. So present, pag-usapan nyo. Fast lang, 3-minute, 5-minute presentation lang of that one-page snapshot. Yun lang. Thank you. Thank you, Tim.
All right. Thank you, guys.
Thank you
Good luck.
again. Thanks, everyone. Enjoy the weekend.